Income tax 2020. Itemized deductions, taxes you pay. Come in, relax with income tax 2020. Itemized deductions, taxes you paid. When thinking about our income tax equation, we're going to be down here in the below the line deductions, looking at the itemized deductions, remembering that we could basically break our income tax formula into two halves. The first half being a modified income statement, second half being the calculation of the tax, then application of the payments and credits to get down to the tax refund or amount due. We're going to be up top focusing in on the income statement half of things, remembering that we can kind of break our deductions into basically above the line deductions up here, below the line deductions down here, the below the line deductions being the greater of either the standard deduction or the itemized deductions. We're focusing here on the itemized deductions, remembering that we only get a benefit from them if they exceed the threshold of the standard deduction, which will vary and change depending on filing status. So we're focusing here on the itemized deductions on Form 1040. That would be down here on line 12. I know this is a kind of a small form here, but we can I want to show the whole form on the slide so you can see it kind of in context. This is going to be the standard deduction or itemized deduction. We're going to be taking the larger of the two. Standard deduction information on the actual 1040 will be on the left, so you can get kind of an idea of how close you are possibly to the standard deduction or how far over the itemized deductions are to the standard deduction. We'll take a look at more examples like this using the tax software examples where we'll zoom into the tax forms in a future presentation. Taking a look at Schedule A then, here's the Schedule A itemized deduction, which pulls over to that line on the Form 1040 if we are indeed itemizing. And we're focused here on the taxes paid. So we're looking at taxes paid, and if you just look at kind of the layout of the form, you get an idea of the taxes that will be paid, and then we'll go into them in more detail as we go through the presentation here. But just note, when you're looking at taxes that you're paying, you're thinking state and local taxes, because what we're talking about here is the federal income tax. That's what we're focusing in on. You're not going to get a deduction for the federal income tax because, again, that would kind of make like a circle loop reference. If you work with Excel, you give it like a circle reference if you were to do that. If you were to deduct the taxes and then calculate the taxes on the thing after you deduct the taxes and so on and so forth. So we're not talking about the federal taxes that are being paid as to whether they might be deducted or not. We're talking about state and local taxes. So remember, the states are separate from the Fed. The state's separate from the Fed, and then we're basically saying that possibly you can take those state taxes and deduct them for federal income tax purposes, which kind of causes confusion. I'm not sure they should have put it in the first place, but now that it's there, you can't really take it out. In any case, you got these state taxes. So state and local taxes deductible for the Fed. That's what we're thinking about here. Now, obviously, you have the state taxes that might be paid as you're making your tax return here. Meaning, for example, here we're going to be looking at a California state taxes. California has state taxes, income taxes, and therefore that will help to be calculated as you do the tax return for the state tax return in conjunction with the federal tax return, and the software will typically help you out then in those cases to calculate the state tax that might be deductible in those cases. So that might be the case. Notice that some states may not have income tax. They might choose to tax in some other way, and generally the idea is that the Fed should not be mandating how the state taxes. And that's why it's kind of funny to have this, the deduction on the federal tax return, because it kind of influences what the state does, in my opinion. But that means that the state could use a sales tax if they chose to. They can basically use a sales tax. And that's why you kind of have to choose sometimes between a state income tax and the sales tax in terms of what type of deduction you're going to get here, so that now the federal government doesn't basically favor states that are choosing to do on their own standing whatever they want to do in terms of how they're going to tax people within their individual state. So note, we also have taxes typically for property taxes. We could have property taxes, which could be state and local taxes. And one of the big things on property taxes is often if someone owns a home. If someone owns a home, they might have property taxes that could be included here as well. So remember, when you're thinking about taxes, it's often one of the big things that pushes people over to being able to itemize, pushes people over the threshold, going over the standard deduction. That's because basically if they own a home, then they probably are paying mortgage interest on it, which could be a big deduction on the itemized deductions, and they probably have a significant amount of property taxes, especially if they're in high income or high cost of living areas, states such as California or say New York, and those taxes could push you over. Now there's a cap to the state taxes as well. They're kind of limiting the state taxes. That could be removed possibly in future years, but just note that that is there, and that's going to enter the smaller of 5D or the $10,000, 5,000 if married filing joint. So we have that cap that we'll deal with. We'll talk about that as we go through here. So the general idea here then is that the state taxes may be deductible if they're state and local taxes. Property tax is going to be one of the big ones. Income tax, or if it's a state that has sales tax, then the sales tax. And then some smaller taxes may be deductible, such as like DMV taxes, the taxes on, the portion of the DMV fees that are taxable, and so on. That's the general idea. Okay, disclaimer, note that the 2020 tax forms or the Schedule A form is out, and we'll be using the 2020 tax form. However, the instructions for the Schedule A aren't out for 2020, so we're starting with the 2019 information and making alterations where they're going to be effective. Obviously, if you have a question about the state taxes in the future, once the 2020 instructions are out for the Schedule A, that's probably where you want to basically start your research. So we here are taking the 2019 instructions that are out at this point in time, even though the tax form for 2020 is out, making any adjustments that we need to them, and just be aware of that as the starting point. Again, if there's a more detailed or nuanced situation you want to look at, take a look and research starting with the instructions for 2020 for the Schedule A itemized deductions, which can be found on the IRS website. So taxes that you cannot deduct. So these are things that you cannot deduct in terms of taxes: the federal income and most excise taxes. So obviously, again, you can't deduct the federal income taxes for the federal tax calculation that you're trying to do on the 1040. So it's got to be, that's the thing we're calculating. Possibly other taxes is what we're looking for. Social Security, Medicare, federal unemployment, FUTA, railroad retirement taxes. So these, again, are another form of federal taxes. So when you're talking federal taxes, you're typically talking federal income tax. That's what we're calculating on the Form 1040. And then other payroll taxes, typically, or self-employment taxes, which would be the Social Security and Medicare. Those are also taxes typically that are pulled out of the W-2 income, or are pulled out of or forced to be paid by employers, self-employed individuals, for example, filing a Schedule C. And they're also federal taxes, and they're not something that can be deductible for federal income tax purposes. Customs duties, federal estate and gift taxes. However, see line 16 later if you had income in respect to a decedent. So state and gift taxes. So the state and gift taxes are kind of combined together. So the estate tax you can think of as kind of a death tax, right? That's like, if someone dies and you pile their money together in a pile, and then the state comes and Fed takes some of it and the state takes some of it, and then you disperse the rest of it out, is kind of the idea. So those taxes are going to be applied at the estate level, and you'll basically be filing, if necessary, if it applies, a return at that level, and then it shouldn't be deducted on the Form 1040. So if someone is asking you about estate taxes and gift taxes, then you can go into those questions, and they're kind of related to some degree, but they're typically held separate from the calculation of then the income taxes. Certain state and local taxes, including tax and gasoline, car inspection fees, assessments for sidewalk or other improvements to your property, tax you paid for someone else, and license fees, for example, marriage, driver's license, and pet. So those are taxes that they're basically excluding at this point. Foreign personal and real property taxes. So if it's a foreign tax for personal and real property. So the deductions for state and local taxes is limited to $10,000, $5,000 if married filing separately. This was a fairly new adjustment, and this is a really kind of a controversial, one of the big controversial kind of areas of the change. It might change basically next year. But I think the idea is to pull out, and it makes sense to me, but I know it's difficult to change something after it's been in place for a long period of time. But the idea would be to reduce the complexity in the code, reduce the amount of state taxes that can be deducted for federal tax purposes, and that would also reduce the amount of federal influence that is held over states to be able to manage their state the way they want to manage it because of the differences in taxation. So obviously high tax or high cost of living places seems to be kind of benefiting more from being able to deduct the taxes because basically that means that you're going to have taxes on the state side, but you kind of get some of the money back because you get the deduction on the federal side of things. So it seems like it's kind of subsidizing high cost of living type of areas like California and New York. So in any case, this was a kind of controversial point on one of the changes, and we'll see if it changes. It might change basically next year, but that cap then also limited the number of people that might be taking the itemized deductions, because again, they were kind of moving away. They're trying to move away from itemized deductions and having more people take the standard deductions. And by capping the state taxes and increasing the level of the standard deduction, that also resulted in less people itemizing. So somewhat controversial here. You can see some debate on that from a political standpoint. But in any case, that's what it is from tax preparation standpoint. State and local income taxes if you don't elect to deduct general sales tax. So note again, and that's one of the problems here. It used to be a while back, many years ago, they had an issue of only being able to deduct state taxes, which were income taxes. And some states might choose not to use an income tax. Maybe they want to choose to use a sales tax, and they don't get it. And again, those states that choose that form of taxation because they think it's better for their state were basically penalized because they don't get the state tax deduction, and the people that had the income tax got the state tax deduction. So they tried to remedy that by being able to deduct either state income tax or the sales tax. And that's basically one of the choices you have to basically make, and that'll depend on the states that you're in. So if you're in like California, where there's an income tax and it's fairly significant income tax, then you're probably going to be doing that. If you're in some other state that has sales tax, then that might be the primary way that you would go, at least with regards to the state taxes for state or sales tax. Okay, state and local income taxes withheld from your salary for 2020. So obviously much of the taxes that you pay if you're a W-2 employee should have already been paid. We're basically on a cash basis method here. So we're talking about when the state taxes were paid. So you paid them in the year that you earned, because if you're a W-2 employee, they were taken directly out of your wages and paid to the government, and those are the state taxes we're talking about. So when you file the W-2, those withholdings are basically what's going to pull forward if you're using tax software to Schedule A as the amounts you're going to deduct. Your Form W-2 will show these amounts. Forms W-2G, 1099G, 1099R, and 1099 miscellaneous may also show state and local income taxes withheld. So you might have like a W-2G, which is gambling winnings, and that means that you may have requested or they may have been required to take some of your gambling winnings and pay it to the state. And that means, again, they would report that and you would have already paid it, and that potentially could be something deductible for the Schedule A. Same with a 1099G, a 1099R for like retirement distributions. You might have asked them to withhold for the state, just like you would with a W-2. And if you did, then those deductions are possibly something that could be included on the Schedule A. And 1099 miscellaneous as well, or for 1099 for a contractor could be there as well. State and local income taxes paid in 2020 for prior year, such as taxes paid with your 2019 state or local income tax return, don't include penalties or interest. So in other words, it's quite likely that, or it could be the case, normally if you're a W-2 employee, then hopefully you had a little bit of a refund on both the Fed and the state, and therefore whatever you paid in say 2020, if you get that, you're going to deduct it, even though you're going to get some of the refund, because if you get a refund, you may have to include it in income. That's how we'll remedy that. But the amount of payments that you made, that's the amount of the deduction. Now, if you underpaid, then you might have to pay some of the tax when you file the return. So if when you filed the 2019 return, which you filed in 2020, April 15th of 2020, you owed state taxes, then you paid those state taxes in 2020. And we're on a cash basis method with regards to state taxes typically. So although the taxes were tied to 2019 return, they were paid in 2020, and on a cash payment basis then, because they were paid in 2020, they will be included and possibly in the state tax deduction on Schedule A. Now again, the tax software really helps with this type of thing. If you filed the tax software last year and you roll it over, then these kind of rollover things for the state tax payments should basically take care of themselves. But you want to understand basically the rules. You're in essence on a tax basis method for the taxes. State and local estate estimated tax payments made during 2020 included any part of a prior year refund that you chose to have credited to your 2020 state or local income taxes. So if you made state or local estimated tax payments in 2020, the ones that, again, you paid in cash, basically you paid in 2020, and that's usually when you have like a Schedule C type business and you had to make estimated payments, then the payments you made in 2020 would typically be the ones that would be deductible, again, pretty much on a cash basis. Now note that you could have had a prior year refund from the state. That's what they're saying here. So if you had 2019, for example, and you had a refund from the state and you said, don't send me a check, but rather apply it to the estimated tax payments that I'm going to need to make, that's going to be a first quarter payment typically applied in 2020. Then you didn't make a payment in 2020, but you rolled over the refund, and that's basically the same thing. Instead of them paying you and then you paid them back, they just rolled over the refund, and that's basically a payment. Again, tax software will help you to pick that up if you're going to be doing the tax return from one year to another. Mandatory contributions you made to the California, New Jersey, or New York Non-Occupational Disability Benefit Fund, Rhode Island Temporary Disability Fund, and Washington State Tip Caution. Now, note, these are items that I'm not in those states, so I'm not an expert on those. So you want to basically do your research further if those are going to be applicable to you. State and local income taxes if you don't elect to deduct general sales taxes. So we have the mandatory contributions to the Alaska, California, New Jersey, or Pennsylvania State Unemployment Fund, mandatory contributions to state family leave programs such as the New Jersey Family Leave Insurance FLI program and the California Paid Family Leave program. Again, these are a little bit outside, the norm, so you might want to do some more. Just make sure you do your research with regards to those items if you have questions about them. So don't reduce your deduction by any state or local income tax refund or credit you expect to receive in 2020. So in other words, if you think you're going to get money back from, like, say 2019, let's say you overpaid the state taxes, and you're saying, okay, now possibly I took a deduction for the state taxes in 2019, but some of it I overpaid, and they're going to give it back to me. What do I have? So you might think, well, then I should either amend the 2019 return because I over-deducted possibly, or maybe I reduced the deduction in 2020. And no, that's not what you're going to do. Instead, you got to say the remedy for that is to say, well, if you over-deducted in 2019 and then you got a refund of the state taxes, for example, then you're going to include it in income in 2020. So it's not really income, it's a refund. But we're going to count it as income because you took a deduction for it in the prior year. So that's how they're going to remedy the overpayment that's going to be happening generally. So if you overpaid the state taxes in 2019, you're going to get a refund. That refund isn't income, but you got a tax deduction for it possibly last year if you itemized. Therefore, you're not going to adjust the deduction this year, but rather you're going to adjust the income side of the formula, possibly including it in income. We talked about that in the income section if you have more questions about it. Refund of or credit for prior state and local income taxes you actually received in 2020. Instead, see the instructions for Schedule 1. So it's going to go on Schedule 1 typically if you get that refund. And we again talked about that in a prior presentation on the income side of things. State and local general sales tax. If you elect to deduct state and local general sales taxes instead of income taxes, you must check the box on line 5A to figure state and local general sales tax deduction. You can use either your actual expenses or the optional sales tax tables. So now this will pretty much depend on what state you are in. If you're in California, there's typically a pretty high income tax for the state. So you're probably going to be choosing the income tax. If you're in another state that depends primarily on sales tax, then your primary custom will probably be sales tax. If you choose sales tax instead of income tax, then you can either count up the sales tax, the actual sales tax, which might be useful if you had like big purchases or something like that, or you might use the tables, which are going to give you kind of the average sales tax. So you kind of have an option of the easier method, tables typically, or adding up the actual sales tax, the more difficult method. Obviously, if someone has income tax, you're typically going to be calculating the income tax when you do the tax return and be reporting the payments that were made with the W-2s and whatnot. Sales tax is more difficult because it's not really tied to, you're not going to be doing it at the same time. That's why you might be using the tables here, and it might be a little bit more complex. State and local general sales tax, actual expenses. So now we're thinking about sales tax, and we're thinking about basically electing the sales tax as opposed to the state income tax. Generally, you can deduct the actual state and local general sales taxes, including compensating use taxes you paid in 2020 if the tax rate was the same as the general sales tax rate. So remember, when you're talking about sales tax in the U.S., the United States, then it's going to be a state and local tax. So you're talking sales tax. On the federal side, we have basically the income tax. Food, clothing, and medical supplies. Sales taxes on food, clothing, and medical supplies are deductible as a general sales tax, even if the tax rate was less than the general sales tax rate. And then we have the motor vehicles. Sales taxes on motor vehicles are deductible as a general sales tax, even if the tax rate was different than the general sales tax rate. However, if you paid sales tax on the motor vehicle at a rate higher than the general sales tax, you can deduct only the amount of the tax that you would have paid at the general sales tax rate on that vehicle. Include any state and local general sales taxes paid for a leased motor vehicle. State and local general sales tax, trade or business items. Don't include sales taxes paid on items used in your trade or business. Instead, go to the instructions for the form you are using to report business income and expenses to see if you can deduct these taxes. So in other words, if you have a trade or business and you bought something and you paid sales tax for it, then generally, like if you have if you had a Schedule C sole proprietor business, then you're typically going to include the sales tax either as an expense there or possibly as something that you're going to be purchasing, like an equipment, which will possibly be included in the cost of the equipment and then depreciated. So therefore, you'll still get the deduction, but you're not going to deduct it on Schedule A, which would typically be better, especially if you're not itemizing. And so you would take the sales tax in some other place, possibly on like a Schedule C in some way, shape, or form, if it was a business item. So we have the refund of the general sales tax. If you received a refund of the state or local general sales tax in 2020 for amounts paid in 2020, reduce your actual 2020 state and local general sales tax by this amount. If you received a refund of state or local general sales tax in 2020 for prior year purchases, don't reduce your 2020 state and local general sales taxes by this amount. However, if you deducted your actual state and local general sales taxes in the earlier year and the deduction reduced your taxes, you may have to include the refund in income on Schedule 1. So this is the same kind of general, they're trying to apply the same rule here for the state taxes if they were an income tax, meaning if you overpaid in 2019 and then you got the money, a refund back, you might have to include it in income. So you could end up with that situation with the sales tax if, this is my general recap of the rule, right? If you basically deducted the sales tax in the prior year, say in 2019, and then they refunded the sales tax in 2020, then you might be in that same kind of situation where you would have to include the refund amount in 2020 as income, given the fact that you got the benefit of the deduction for it in the prior year. But if it was an adjustment for 2020, and you got to, they give you a refund, then you would adjust the deduction because it would be in the same year. So then we have the optional sales tax tables. Instead of using your actual expenses, you can use the 2020 optional sales tax table and the 2020 optional local sales tax tables at the end of these instructions to figure your state and local general sales tax. Now, obviously, software will typically help with that as well. So if you're using tax software, they will typically have those tables, and you can take a look, hopefully, let the software calculate the sales tax, and then you can consider whether or not you want the actual sales tax and choose which one to be using. Actual sales tax often being more beneficial if there were large purchases subject to sales tax in the year. So you may also be able to add the state and local general taxes paid on certain specific items.